Welcome to the FinLink Fincast. I'm your host, Zander Heinen. Today we have a really special guest and a good friend, Tom Anderson from Anasova. Thanks so much for coming on, Tom.
Absolutely, Zander. Great to be here. Thanks for having me.
Of course. Let me give a little background on you and your ventures and endeavors in life. I think it's a pretty interesting path you've taken. So Tom Anderson, you graduated from Chicago, right?
Undergraduate was Washington University, and my grad school was at the University of Chicago.
Great school. So you're the founder and CEO, really, of two well-known fintech companies now. The first being Supernova Technology, and that was a leader in securities-based lending, which I'm sure we'll talk about a bit here on this podcast. But also Anasova, which is really revolutionizing the way lead generation is. I think it's really going to change the way lead generation is going to be going forward. I think you have a really great scalable product. You're also a 5 times recognized Barron's top advisor, and that was with Morgan Stanley, I believe.
Some of those were at Morgan Stanley, and some of those were at Merrill Lynch. So, as a decade at Merrill and 5 years at Morgan Stanley.
So you've been through the grind, especially at the wirehouse.
Yes.
On Wall Street Magazine, 40 under 40, and another great accolade is you're an author of 4 books, including the New York Times bestseller, The Value of Debt. You're the first New York Times bestseller I've had on, so thank you so much for coming on. And the book, The Value of Debt, really changed the way I looked at debt. I was definitely bred to, or I was, my pedigree was in value investing, where we didn't look at debt in favorable terms. And when you had your presentation at Andrew Evans' conference a couple of years ago, totally illuminated the way I saw securities-based lending. So thank you for that. And again, we'll go into that a bit. But really, let's get a quick a quick clip from you on what Anasova is doing and really revolutionizing the way lead gen is done. Typically when I started as a young advisor and young wholesaler, there was a couple ways to get leads, and it was lists. The Glenn Gary, Glenn Ross type ABC, always about closing. Seminars, which I don't think there was a great ROI on that. And then a conversation I have with a lot of sellers and a lot of buyers on the FinLink platform is referrals. And, they think that referrals business is great business, but is it scalable, right? So, yeah, I would love to hear just a little bit about Anasova and what you guys, have created and what you guys are doing now.
Well, thanks so much for having me on. A lot of what we have created is, in fact, inspired by you. So when we were at that same conference and I saw your presentation, we actually reshaped a tremendous amount of the design of what Anasova is and where I kind of see things going. So you provided an unbelievable level of clarity to me on what this market looks like in lead generation. So I think what is really interesting and ironic is that financial advisors are professionally trained at understanding the supply line of markets, of capital markets. So global equities might average, let's say, 10%, and bonds might average 5%. And so you could have a portfolio that's 50-50 with an average return of 7.5, for example. But if a client came into the advisor's office and they said, well, I want to have a 20% rate of return in a 50-50 portfolio, most financial advisors are professionally trained to say, you are crazy. Like,
Get out
that
of here.
world does not exist. And so so the client's demand of, I want to be 100% in bonds with a 20% return on my money, is considered to be completely irrational by a financial advisor. And so then they train, they coach the person to what are the universe of achievable outcomes, balancing different things. But that foundational part, I think, is very, very important, and of course, intuitively makes sense to you, right?
Right.
Okay. So what you taught me is, or what my takeaway from your presentation is, thinking about what you just said, we can take everything from a list, which would just be, random things that we buy, like the Glengarry Glen Ross, reference, to purchasing a business, right? And so we know what the multiple is of a business, and we know what the cost of the phone book is. So let's say the phone book costs 0 today. So what we can actually then do is you can graph the supply line of growth. And that is what my obsession is about. It is irrational for anybody to think that a different supply line exists. And that's the topic that I hope that we can explore today. But you said give it just a quick tease in. I think that there's a very clear capital market line, and we could debate some things around the margin, but there's a very similar line in the lead generation space. And I think the single most important thing for financial advisors to understand is what that line looks like, and then figure out how they can optimize their ROI on that line, how they want to shift their demand to match the supply type opportunities.
So let's walk through for the Luddites out there like myself, even though I'm in fintech, what the process is with Anasova. How do you vet the leads? What is this process in which you get, it's not a list necessarily. So what's the process in
For
which
how our
yeah, how
lead.
you get, yep.
Yeah, so what we've done is, do you mind if before diving into that, we talk very briefly about the big picture components of the supply line of growth? Because I think that
I
will.
would love to. I think you
Oh,
you should definitely take a little look at
okay.
that.
So one thing that you could do that we don't do, but what you do is you help people buy and sell businesses, right?
Right.
And so if I said that I want to buy a financial advisory practice at one-time revenue, I'm probably not going to be very successful in your marketplace. Is that fair?
Yeah, correct.
Okay. And similarly, if I wanted to pay
I wish I could, but
yeah. And if I wanted to pay 20 times revenue, you could buy everybody, but it would be an irrationally high price. So we have like a spread here, right? Roughly, where do you think businesses are in a wide range? Where do you think many practices are trading today? Because that will help frame the value of leads as we move down the supply chain.
yeah, so the average is, three for a financial advisory practice is 3 to 4 times revenue.
3 to 4 times revenue. So if I have $1 million practice in the Succession Link platform, that's likely worth between $3 and $4 million. Is that fair?
Right. Right.
So I like to break that down then. I think it's fair that we could take it to the account level. If I bring in for each $10,000 of revenue that I generate, so $1 million account at 1% is going to generate about 10,000 of revenue. And taking what you're saying, because this is the part that you're the expert in, my net worth goes up by about $30,000 to $40,000 for each $1 million account that I close. Is that
Right.
reasonably
Yep.
fair?
Yep.
Awesome. So if I could pay $20,000 for it, I could in effect, for a closed account, I could in effect resell it in your marketplace. Just not, I mean, there's frictions here, but conceptually, if you could pay 20, you could resell it for 30 or 40, and that would be a 50 to 100% ROI. Does that
Right.
kind of make sense?
Yep.
Okay. So anchoring on the value of a closed account and the value of closed business is one end of what people could do, but it's tremendously expensive to spend $30,000 to buy that account that's generating $10,000 of recurring revenue. So the next step down on the supply chain would be things like the custodian referral programs, or often called CRP. These would be things like where Schwab has a platform and they'll say, hey, Zander, I'll send you referrals, but you're going to give me basis points for the life of that relationship. So it is a way to have scalable referrals, if that makes sense, that are coming from platform to advisor, but there's a recurring fee forever that comes out of that. Good on this?
Yep.
The most amazing part of that business is it changes the unit economics, because if you're taking a skim that's right off the top, but pushing all of the expenses and operation at the advisor level, we can debate good or not trade, but that's one other entry point. The next entry point down is what are called sales qualified leads. Sales qualified leads, in theory, are people who want to talk on the telephone to potentially have an appointment with a financial advisor. So you can get into two different types of sales qualified leads: those who are actually setting an appointment and you're paying by the appointment, or those who are willing to have a phone call giving you the opportunity to set the appointment. The largest firms quantify the value of sets, because even most normal-ish financial advisors say, hey, if I have 3 meetings, I can close 1 in 3, for example, or I can close 1 in 4. So therefore, the value of what's called a set might be, for example, $2,000 on the account. The value of a phone call, if it's an exclusive phone call, that would be through something like Unbiased, which is a partner of ours in disclosure. That would be, you know, kind of in the, let's call it $400 to $1,400 range, an exclusive lead phone number having a call. Smart Asset is a firm you've probably heard of. Smart Asset will do sales qualified leads with a phone number with people who, in theory, want to talk. And those are like $250, but they're sold 3 times. So you can kind of think of their revenue multiple being 750. Quick pause and check in. Are you starting to see the formation of the supply line? Because we just went from 30,000 to 250.
Yep, I saw that. That was
Okay.
pretty apparent. Yeah.
So what about the other end of the spectrum? So our data is really, really interesting. So we got data from 20,000 consumers by just asking them surveys. And the way that we do that is we have the website, freefinancialplan.com. We also have the website, aifinancialplanning.com, and we just direct traffic to these 2 sites. Comes in a lot of different ways, and we'll talk about that. But we get to ask people all sorts of questions, and we do different tests as thousands of users come through this system. What percentage of people do you think want to talk on the telephone to a financial advisor as their first point of interaction about their money?
I don't even, well, historically,
Now, present
it's not
day.
high. It's not high.
What are the chances that you would talk to an insurance agent on the telephone if your phone rang right now?
Probably 0
0, right?
for
I
me.
mean,
Yeah.
if my parents even picked up the telephone and started talking to somebody that they don't know on the other end of it about their money, I would like tackle them. And it's that's like a violation of cybersecurity 101. Like,
And mind you, our entire industry was built on this model for a long time. So
right. It's really absolutely ridiculous. So there are some 65-year-old and older who will talk on the telephone. But as you move below 50 years old, I cannot get my children to talk on the telephone with me. And granted, they're like a bit younger, but like in this spread, it doesn't matter what's going on. They don't use the telephone. My phone doesn't ring unless the number is actually in my system. Like,
yep.
if that is a part, you are not supposed to answer unknown numbers. One
Yep.
chance is it's an emergency. The other one it is, have you seen The Beekeeper?
No, I have not.
Oh, it's like, it's crazy. It's that Jason Statham, like, it's all about like fraud and things like that. Like,
I saw it on the Netflix and was thinking about watching it, but
it's
again,
not going to get like an Oscar, but it's worth like a quick, a quick look.
it's entertaining,
So,
like most Jason Statham movies.
so, so financial advisors want their first point of interaction to be a phone call, or they want it to be a meeting, or what you said before, I want you to come to my seminar. Ask my wife, we have 5 kids, so my house is chaos, but ask Allie to carve out time to go to a financial services seminar. Like, it's just, that's not happening. And you're also not going to talk to her on the telephone. So we have a lot of research on this, but it's simple and intuitive that the first step for people is not natural to want to have an appointment, and it is not natural to want to have a phone call. It applies to less than 2%. And basically, those 2% are crazy people. It's like, of course, there's irrational people, but this is fundamentally important. Does it make sense so far?
Yes, very much so.
So, what we have discovered is that if it, there many people where you and I started in the industry was, so I'll do it for you right now. Hi, my name's Tom Anderson. I'm with Merrill Lynch. I'm calling to see if you're an investor, and if you are, if you're open to ideas from time to time. Quick shout out to Gio Bernetti, greatest cold caller ever. That was his line. I just completely took it. Are you an investor, and are you open to ideas? If yes, you're an investor, and yes, you're open to ideas, then I got permission to mail. It is now my job to share quality ideas with you, to have no expectation of you doing anything now. This isn't like boiler room stuff. It's just now I have permission to send you high quality ideas, earn your trust, and open up the account. Anasova is meeting people where they are with what they want. We're finding people who are engaged in the financial planning process. They're online typing something related to financial plans. Our site surface, either through SEO or through ads that we run, they click on it, they come through a funnel and they run a plan. The average person is, by the time they've clicked, gone to the landing page and run it, they've spent more than 5 minutes engaging in this whole process. At the end, they give a guaranteed valid email address because they don't get their plan, and no phone number. We don't ask for it because they don't want to talk on the telephone.
Smart.
So they give financial data, permission to mail, and a guaranteed valid email address. Our leads cost on average about $20. There's a range, $1 to $100. So, but for $1 million lead, a pin for discussion is they're about $20. So the concept is, if you can, it's back to the future in lead generation. If you can build a large audience, nurture it, send high quality ideas, fruit will come from that tree, because once they know you from your ideas, they're more receptive to a meeting. From that meeting, your close rate goes up and the ROI skyrockets. And that's where in the supply line, Anasova is. And then down from us, you have cold lists, clicks, and everything else. So we have a level of intent, an interest in planning, an openness to ideas, but I'm only going to give you my email address to start our relationship. That's what we do.
Let's go back just a little bit to the my financial plan, my financialplan.com,
Yeah.
and kind of the history of that, because I believe I'm correct in saying this, but originally that was the idea for Anasova, right? You wanted to provide free financial planning with leveraging AI and technology, and very quickly you understood that these people, once they got that plan, they needed more advice. Can you
Yeah.
go through a little bit of the history of that, and what really created the need for this lead generation portion of Anasova?
Yeah, you have a great memory. I love that you remember that part of the history. So
I listen to things that I'm interested in, but that's about it.
that's all factually right. So we started out direct to consumer, and what we found was, I honestly thought I had discovered gold. Our click rate, our open rate, our engagement rate was off the charts. Like when you give them a plan, any engagement metric that you want to measure is ridiculously high. And then from there, the drop off to action was bigger than you could possibly imagine. So the simple concept is, I can get you on a Saturday morning while you're having a cup of coffee and sitting in your PJs to run a financial plan online. That's an engaging topic that many people with money are interested in.
Yep.
However, if I say you need a will or you need insurance, click here to do that, the whole chain breaks down. So they're engaged, but they aren't going to take action at that point in time, which is in retrospect makes perfect sense. I can imagine myself in that exact position. Oh, that was interesting information, super cool. My kids are screaming. I have to go on with my day.
Yeah, I'm done with this. Yeah.
I'm done with this. I gotta go play pickleball. Whatever the deal
Yep.
is, I'm not taking the next step. So what we realized is much more effective for both the consumer and the advisor to say, here's an opportunity to nurture somebody. So the analogy that I like to say is, on a Saturday morning, you could either be doing that, or maybe you're looking at friends of ours went on a Ritz-Carlton cruise. Okay. And so I went and looked at these cruises, and the boats are beautiful and the destinations are amazing and the food looks great. Right. So somehow they got my email address. Now the Ritz-Carlton just sits in the background and they send me pictures of pretty boats and beautiful destinations. And when the time is right, I can engage with them and ultimately I'll do the trip, but they don't care when. And they're just nurturing me passively, but it was a fully digital experience for both of us, non-intrusive.
Yep.
That's what this is all about.
And it really plants the seed in the back of your head. So when you're ready, you click on the.
Yep. Yep. Want to know what's amazing about that?
I'd love to hear it.
Most advisors don't have anything to say.
Really?
This has been my latest challenge. You can literally get gobs of beautiful people into the club, and then it's like they're standing up against the wall, like not engaging. It's really that has been one of my most interesting things to see. We estimate that 1/3 of our purchase leads are never contacted.
I blame that on ChatGPT.
Why is that?
This AI has taken over everything. It's like we don't have to do anything anymore. So it's like, why can't you sell for me? It's like
Yeah, it is. Like I want to just have something in the background. So what's really neat is we have a widget that we built where you can take the plan, upload it to AI and say, what do I say to this person? It will actually craft
that's smart. That's what I'm talking about right
lines.
there. Ding ding.
It'll even help you create kind of like your ongoing nurture campaign. But yeah, so I mean that's part that we aren't so AI it can help solve that, but people are very receptive to ideas. If you have advisors who have ideas to share, that's beautiful, but they want to receive that information via email to read, to think about, and when the time is right, then they want to reach out. It's natural, it makes sense.
Yesterday I had coffee with a young advisor, and from my background and my uh, career in sales and financial sales, I was trying to give him some seeds of knowledge, I guess, and just what to look out for, what not to look out for. And in speaking with him, and he works for a very large, well-known firm, there has been a huge decrease in the amount of funding going to a junior advisor sales training.
Yeah.
So I brought you up, and I said, you might want to talk to Tom, and you might want to check out Anasova. And I'd love to get, your thoughts on why this would be such a huge game changer for the young advisors who are coming in the field, who don't have that training. Maybe they have, a couple hours of elevator pitch sales training. But I think the big thing we focused on yesterday was he was pretty afraid of the boiler room, Glengarry, idea of hard sales, boiler room sales, which has been instilled in us through Hollywood, I think, for a long time. And he's more of a soft seller. And I thought it would be a good conversation for you to have. But what would you tell young advisors who want to utilize this platform to grow their book? It's a very challenging environment for them right now, and why this would be a good idea for them to maybe implement.
So uh, two different things within your question, and I'll hit both. Well, you didn't ask this part. What's so interesting is established advisors get breakthrough in the business, and like it is so much easier to take a $500,000 producer and turn them into $1 million producer. It's easier to take a $1 million producer into a $2 million producer. But so many advisors turn off their growth engine, which the hardest thing is to get to that first 500,000 in production, which is what we're going to talk about. But why so many advisors turn that switch off as they get closer to retirement when the value of their practice would accelerate if they continue to grow? I do not know, and we should have that as a topic for another thing. It is easier to grow.
That's like the Charlie Munger, the
Right.
first $1 million is a real pain in the butt. But
Real pain. The first 500,000 in production is a real pain. And so then even more in particular, the first 100,000 is a real pain. So how do you get there? And I think the way that you get there, so my mom was a financial advisor. Did you know that?
I believe you mentioned that.
Yeah. So she taught me I led with CDs. Okay. And
The fascinating
this
financial
is
product.
like old school. But the interesting thing was I was looking for people who were interested in purchasing CDs. And here's the process that goes behind that. And I'm going to bring it into present day and not tell dinosaur stories, but we have to stay in this world for a second, okay? Multiple things happen. If I'm calling you from an established financial institution and we're talking about CDs, if you are a purchaser of CDs, you're automatically qualified for more things later, okay? You're not intimidated to open an account with me, and a CD is a certificate of deposit that is insured. And so it's a comfortable first step to open the account and move money in the door.
Mhm.
What a lot of and the reason so muni bonds was also a great way to lead. What happens is new advisors do not understand. Ask me to move hundreds of thousands of dollars from my account into you. That's
Yep.
that's a ridiculous ask that's very difficult for me to take as my first step. And what's broken down is that first step of trust building, opening the account, doing some business together so that I have the right to earn more of your business. Too many young producers are operating in this. The first step someone will take with me is ACAT, $2 million over. That's not the first step.
Scary.
So what they need to do is figure out what is a way that they can move a tenth of their wealth in the door to try something with you. What I have found, which we won't be able to fully cover today, that we will later, or I can go on for however long you want to, obviously, but that's I like leading with cash. I like leading with lending solutions. I like leading with indexing. So if you're a young advisor, it is a fact. Zander, you should have some portion of your money in a low-cost global equity index fund. That
Yep.
portion should not have a fee on it. Just how fast you're nodding your head, that is factually accurate. If the young advisor leads with move money in and put it in an index fund with me, I'm not going to charge you a fee. Now, so that's terrifying to the young advisor, but you're creating trust with the person. I don't have to charge a fee on all of your assets. In fact, your current advisor is charging a fee on all of your assets. You can beat them by saying you're getting screwed right here. And that starts the conversation. But you're the judo guy, man. Like you need to take their energy. It's jujitsu for you, but you got to
Jiu-jitsu.
take that energy and change it, right? So that's what you're trying to do is like lean into the obstacle. You think I'm going to charge a fee on all your assets? No, your current advisor is. You should index with me. You've got my ear. I want to know more. You're building trust with me.
That's awesome insight. And getting that initial call with a client, it'd be pretty easy to do it through Anasova because you have most of the data points, right? Like you've already had the initial conversation that takes 4 or 5 conversations of cold calling. You have these data points where you know enough about them if they're divorced, if they have kids, if they have a Roth or a 401k, etc. So it's almost like a client. Uh, I don't know the term, but like the client is looking to for that information, and they get a conversation out of it because they need that information. They're the ones interested. They've initiated the need for this type of help.
Yeah, I want to manage expectations though. What's so interesting is the people come in, they gave a tremendous amount of data. You get a copy of their plan. You literally short-circuited 5 conversations. 1/3 of advisors don't respond to the leads, which is amazing. Let's talk about the next third. They send canned content, not leveraging
Yeah.
any of the data in the plan, asking the person to click on a link and call them.
Yep. Yep.
I just gave you all this data. Give me an idea. Tell me something. Give me a reason to call you. Don't let what is the reason? So that they shirk their responsibility onto the client. That's not how it works. Like the process is follow-up. The process is personalization. Advisors who leverage the data to say, hey, you're getting close to college. I know that because you have a 16-year-old kid, you are thinking about college financial planning right now. I have an interesting planning idea for you. Forget about it. And the reason,
Yeah, I think there's a huge overlap there with what we see on the FinLink platform, where potential buyers reach out to sellers anonymously, and there really isn't any thought or any type of crafting of the message. And I think that's something that we can both try to instill in the listeners of this podcast is really take time to think about it, and really sell yourself. Like, don't sell yourself short by putting the onus on the seller. Really, pitch yourself and sell yourself, and take time to do that. Don't just it's not a numbers game. It really is. People
exact
see
same
this.
thing. Every advisors are approached all the time. I want to buy your business. I want to buy your business. That message is dead on arrival. It's
Yep.
there's nothing to oh, thank you. I'd never heard that before. I can't wait to talk to you. Like that doesn't that's that so it is it's not kind of the same, it's exactly the same. Yes.
Yeah.
A reason, a hook.
Well, we're getting to the kind of the latter half of the podcast, and I did want to follow up on the value of debt. And when I heard you give the presentation on securities-based lending, and I just think this is a great little nugget for all of our listeners, is, people hear, securities-based lending, which used to be margin loan, or however you want to dice it. It's debt, it's scary, people are adverse to it. But you gave a really good uh, kind of overview on why it would be helpful for more so for high net worth clients to utilize it. And I think you used like the example of leasing a Mercedes. And I just wanted to actually hear that, not only for our listeners, but for myself again, because I thought it really resonated with me, and I've been waiting to hear it again. So if you will, I'd love to hear that again.
Yeah, absolutely. So first of all, 70% of people of all net worth spectrums borrow money. And as you actually go up, if you reach up to, for example, billionaires, when I say what percentage of billionaires do you think borrow money, most of the room will always respond like all of them, right? So
Yep.
companies borrow money. The strategic use of debt is Modigliani Miller, and it is a foundational part of Nobel Prize. It's also a part of Tobin, Sharp, and Markowitz. It's what we should be doing. It is also foundational that the decisions you make with debt shape your quantity of money. Your quantity of money shapes your long-term outcomes. So any advisor that's not talking about debt is not delivering comprehensive, integrated wealth management ideas. So the personal balance sheet matters foundationally. The example that you're talking about is like where it becomes really fun and practical. So
Yeah.
debt, if you borrow at 95% LTV, then that is risky and reckless. If you borrow at 5% LTV, then like you're fine through the Great Depression. So you can have this bid-ask spread of where things are, but a little bit of debt can enable life to be enhanced safely. And what's an example of that? If I have $1 million portfolio and I want to buy a $60,000 car, okay? If your securities-based line of credit costs 10%, which it doesn't, none of them have a rate that's that high. It's just going to make our math easy, okay? 10% times 60,000 is $6,000 a year. 6,000 divided by 12, your car payment is $500 a month.
Right.
Your required payment is zero. You could let it cap and roll. And that isn't necessarily a good long-term strategy, but it gives you a tremendous amount of flexibility. So if you are, so doctors, lawyers, small business owners, when you see a Mercedes or a Land Rover, Range Rover, these are leased cars because it's not a path to wealth creation for them. It's something that they want to have. And all of those are on base and bonus type systems. So I don't want to have a Mercedes or Range Rover, a country club, private school, first and second home, all these payments become too high. If I can have the flexibility to pay down when I want to, you completely change the game. This is before I even get into rate. You take that rate down to closer to 5-6%, but for easy math, the 5, that payment now is $250. I'm putting you into a $120,000 car for $500 a month, no required monthly payment. You cannot do anything else. And if I am keeping that at under 30% LTV, you are making the pie bigger effectively for people. And that's the story that people want to hear. That opens the door.
I loved that. That is such a great nugget. And then the other thing I remember was, I think you asked the audience, how many S&P 500 companies have debt
Right.
on their balance sheet, and it's like 100%.
Right.
There's like maybe 2 or 3
lines of credit. Some people listening to this are CFPs. It is like literally on page 1 of the CFP book. Open up lines of credit in good times, access them in bad times. But yet in the wealth management world today, 95% of clients do not proactively have a line of credit set up with their financial advisor. Financial advisors are letting people turn to banks. But if you go to a bank and get a loan, then I missed the opportunity to provide the advice proactively about how this fits into your plan, because that decision will shape your financial plan. If a personal CFO has to be there proactively guiding them to the right types of solutions. That might be at a bank, but if you're not the first point of contact, you're already on the back foot. You're losing.
Yeah, and it should be an arrow in every quiver of every financial advisor.
Yep.
In my estimation. So it was the first time hearing that from when I heard you speak about it, and I thought that was a really, really interesting conversation we had afterwards. So, well, I don't want to take too much more of your time, and I know that you and I are going to be doing a lot of things, a lot of webinars. We're really going to integrate, how organic growth and inorganic growth can kind of come together, and I think you and I are going to make some really neat content and hopefully innovate for the FinLink community going forward. So I just really wanted to thank you for your time, Tom, and really appreciate you jumping on and being a resource partner. All of our listeners can find Anasova's lead contact form on our resource page, but also it's anasova.com. They can also look up. You have some great stuff. You and Britton, you're she's the head of she. I don't even know what she does. She's really smart.
She's very, very smart. She's the CFO and head of strategic partnerships.
Yeah, CFO. Yeah, she's great. So, yeah, thanks again, and I look forward to working with you and really making some headway here.
Well, thanks for having me. And I can't wait for us to create content together, because I really think that together we can teach this concept of the supply line of growth and the value of growth. If the first book was the value of debt, why don't you and I create the value of growth together? We can literally show people what it's worth in their long-term net worth to keep that growth engine on, and exactly how to do it to optimize their ROI.
I would love to. I was an English major and I have a finance degree, so.
I love it. Awesome.
All right, Tom.
Well, great to see you.
Likewise, and we'll talk soon.
Sounds great.
Take
Bye.
care. Bye-bye.